Today we look at the bull and bear case for Valeant Pharmaceuticals. Valiant is the largest pharmaceutical company in Canada, over $100 billion by market cap, and has made over 30 acquisitions in the last 5 years. Should you own it? We'll take a look at both sides of the argument and let you make up your mind. Joining me today is Anita Brunsma, Canadian equity analyst at TD Asset Management. She'll give us her 3 top points for the bulls and then the bears. Here we go. So point number 1 is product portfolio.
What's really attractive about Valiant's portfolio of products is that it's really well diversified. So they sell well over 1,000 products in 100 countries, and they're not overly reliant on any one of those products. They're also not reliant on treating any one condition or illness. So they do treat chronic and very important or challenging illnesses, but they also treat more sort of day-to-day conditions, things like eczema, dry skin, dry eyes, wrinkles, acne, sort of these day-to-day irritations. The other nice thing about Valiant's portfolio of products is that unlike some of the large pharmaceutical companies, they face very little patent risk.
And number 2 is acquisitions.
So Valiant is a deal-making machine. It's really their bread and butter, and it's what has allowed them to grow as quickly as they have. And they're very good and very successful at their acquisitions. And the reason for this is they're able to realize a lot of synergies. So synergies is when you buy a company, you take out the cost, and you improve the earnings stream. And so they've done this mainly by cutting the workforce in administrative functions and also in research and development. The other advantage that Valiant has when making acquisitions is its tax rate. So it has a very low tax rate of about 5% by the way the company is structured. So when it acquires a company, it applies that tax rate to the new company and improves the earnings.
And number 3, organic sales growth.
Organic growth has been an important focus for Valiant. Organic growth is essentially the growth of your existing product base, not including the acquisitions that you're making. So it's an indication of your long-term growth. Now, Valiant had reported quite a number of quarters with weak organic growth, but starting in Q3 of last year, their organic growth suddenly accelerated to 19%. And then the next 2 quarters, they reported a 16% organic growth rate and a 15% organic growth rate. And management thinks that for the rest of this year, it can achieve at least 10% organic growth, and it does this through increasing the pricing on its existing products and also introducing new products.
So number 1 is acquisition risk.
So as I said, Valiant has made dozens of acquisitions, and they've been very successful at it. But any company that makes acquisitions faces acquisition risk. So one of the risks is integrating the company into your own company. Another risk is a company may overestimate the number of synergies, the amount of synergies they think they'll be able to realize. But for Valiant, I think the bigger risk is size. So as Valiant gets bigger and bigger, it needs to make bigger and bigger acquisitions to move the needle on its earnings. And there really are 3 problems with this. The first is you have to find a company that's big enough to move your earnings needle, but still fits your investment strategy. And the second one is when you find a company like this, very often these companies are publicly traded, and publicly traded companies usually get acquired at a pretty significant premium to the market price. And lastly is integration. It's pretty easy to integrate a company that has 10 employees, but one with 1,000 or 10,000 or 100,000 employees is much more complicated to integrate.
Number 2, debt levels.
So Valiant takes on a lot of debt to make their acquisitions. They currently have about $26 billion of debt on their balance sheet. And when we look at the debt of a company, we look at the debt to EBITDA ratio. So this is the company's total debt divided by its annual core earnings. For Valiant, their debt to EBITDA ratio is about 4.7 times. Now, context is really important. So if we look at a group of global large pharmaceutical companies and some specialty companies, they on average have a debt to EBITDA ratio of 1.2. So 4.7 versus 1.2, that's a very big difference. And so it's very important to consider these debt levels because it generally indicates a riskier company.
Number 3, complex accounting.
So Valiant's accounting is quite complex. One of the reasons it's complex is because it uses non-GAAP measures. So a non-GAAP measure is a measure that doesn't have a standard accounting definition and it isn't audited. So essentially a company can decide how it wants to calculate that number and how it wants to present it to investors. So Valiant relies heavily on what they call their cash EPS number. So their cash EPS number is derived by taking their GAAP earnings per share number, which is the standard definition. They make 13 adjustments to that number to get to their cash or adjusted earnings per share number. And this is what investors look at. So it's just very important as investors that we make sure we understand what those changes are that they're making and that they're applying them consistently quarter after quarter so that we're comparing apples to apples.
So a very complicated company, it definitely sounds like. What's the word on the street? What are people saying out there?
Well, there are definitely more bulls than bears on Valiant. Analysts believe that Valiant will continue to make significant and accretive acquisitions. It will continue to grow. And the analysts also believe that its organic growth rate will be at least 10%.
What's your opinion?
Well, we believe that Valiant's done a very good job with its strategy. You know, it very clearly laid out its strategy and it's followed it and it's been very successful. But we feel that now it faces headwinds. The biggest one being its size, as we talked about, and having to make those larger and larger acquisitions. And along with that, they have the high debt levels. And I also worry about the organic growth rate over the long term. There are other risks to the story we didn't talk about. One of them is, for example, their tax rate and some risks to their tax rate. So overall, as a long-term investment, I believe that the risks with Valiant outweigh its opportunities.
All right, thank you very much, Anita.
Thank you.
So there you have it, the bulls and the bears with Anita Brunsma, TD Asset Management. Thanks for watching. I'm Marianne Devenney.